Okay, so now we continue with our discussion, and now we're going to look at transaction price allocated to the remaining performance obligations. Remember that the remaining performance obligation amount will not be in the revenue figure on your statement of comprehensive income because it has not technically accrued to us. But we know we are expecting to receive revenue with respect to contracts in that revenue stream over the next 2 years or the period that's stated in the contract, right? So the standard says for these remaining performance obligations, show what you're expecting to receive over the next few years. So in the revenue note to your annual financial statements, the company should then disclose the aggregate, meaning the total amount of the transaction price allocated to the performance obligations that are unsatisfied or partially unsatisfied as at the end of the reporting period. So this means that we can't include in the revenue figure at year end, but we know we will receive this revenue in future periods. And that's what we would include. That's the amount we include in this disclosure. We also then need to explain when this revenue is expected to be received. Okay, so we should give it like a timeline. Within the next year, we expect to receive so much. Within the following year, we expect to receive so much revenue. But you have options to disclose this time span or range with its related figures, right? You can either choose a quantitative option or a qualitative option. So I'm going to discuss them both now. The first one is on a qualitative basis, so similar to the example I just gave, that maybe within the next 12 to 24 months, we expect to receive so much revenue, and the time after that, so we then split it up into the different years. So using the time bands that would be most appropriate for the duration of the remaining performance obligations. So this is demonstrated very nicely in illustrative example 42, contract B and C. That can be found in your IFRS textbook, your Part B IFRS textbook. Right, the other manner of disclosing this is the qualitative information. Okay, so if you don't have the quantity or the exact figures that you're going to receive in the next 2 years or next few years, but you know that you will be receiving the revenue and there is a basis or a plan that is applied to receive the revenue, then you must explain this in that revenue note. So another example that illustrates the qualitative disclosure in this regard is example 43 in your Part B IFRS textbook. So it's a short example, but it gives you an idea of what such a disclosure should state. We look at when an entity does not need to make all of this disclosure. So an entity does not need to make all of this disclosure if the performance obligation has 2 conditions which should be met. The performance obligation is part of a contract that has an original expected duration of 1 year, or the revenue from the satisfaction of the performance obligations is in accordance with paragraph B16. So performance obligations in terms of B16 is, for instance, a contracted service is rendered by the entity that is billed or charged at an hourly rate, right? And then this rate is fixed. Then the invoiced amount may be recognized as revenue. So for example, a car dealer company has a fully glass paneled showroom. So they need someone to keep it clean, right? So they enter into a contract with Window Wash Limited to keep their windows clean, and the contract is valid for, say, 4 years. The window washing service is not charged per window, but it is charged per hour as a fixed rate of, let's say, 100 Rand. So would you say, is this a B16 contract? Yes, it is. Okay. So please note that this is just my own example for explanatory purposes. This is not in any tart letter or anything given beforehand. So yes, now this is a B16 contract. So what? What do we do? How does this affect my disclosure? Well, first we have to establish the number of hours that Window Wash Limited staff worked on the car dealership windows. Let's say they worked 37 hours during the reporting year. That means that at the end of the year, the window wash company is entitled to invoice a dealership to bill them for the 37 hours worked, which then amounts to 3,700 Rand. That is the invoiced amount and may be recognized as revenue by the Window Washer Limited. We cannot then recognize revenue over the 4 years. We can only recognize revenue to the point that it can be invoiced. So to the point where the performance obligation is fulfilled for the current period. Again, a nice example to illustrate this is then contract A in the same illustrative example 42 found in your IFRS Part B textbook, right? It's important to understand this example, and it's not really that difficult once you go through the examples. Then you'll understand how the disclosure for such a contract works. The entity needs to then, in their disclosure, explain even further, right? They need to now explain what did they use. Did they use paragraph 120 or are they using disclosure for paragraph 121? Okay, so remember we said 120 is to disclose all those different aspects for a remaining performance obligation based on the time bands or qualitative information. And then 121 said don't give any of that disclosure if two conditions are met. The revenue contract is less than a year or less than a year, or it's a B16 contract. The standard then says, now tell us which one you're going to do. Are you going to follow paragraph 120 or 121? Okay, and whether any consideration from the contracts with customers is not included in the transaction price. So typically a consideration that's not included in a transaction price is a variable consideration. So for example, you may have an estimated transaction price of 4 million Rand, but not included in this amount is a constrained variable consideration, right? This is now also forms part of uncertainties, which also then needs to be disclosed. You know that the constrained variable is there. There is a value for it, but it's not included in the transaction price. So you need to give this qualitative information about it. So let's look at what is a variable consideration. It is when something about the receipt of an amount is uncertain, like a bonus. To receive a bonus, you will need to perform in a certain way or complete a task within a certain time period. So when do we include a variable consideration in the transaction price or not? The standard says we need to determine if it is highly probable that the revenue will not be reversed when the uncertainty is resolved. For instance, you are reasonably certain that you will get the bonus based on progress to that point or past experience, etc. So it is highly probable that you will then receive the bonus. So you can include it in the transaction price because it is highly probable it will not be reversed. If we cannot establish that it will not be reversed, then we must not include in the transaction price as it is considered constrained. For example, if the circumstances or surrounding risks or past experience indicate to you that you will not be able to complete a project in the conditional time to receive a bonus, then it is not highly probable and must not be included in the transaction price as there is a greater risk of not being received. To help understand this better, it is important again to go through example 42 in your IFRS Part B textbook. So example 42 is very important for these aspects that we've just discussed. And for this particular aspect, it's discussed in contract C of example 42.